develop my slides. I'll actually be discussing CBDCs, motives, economic implications, and the research frontier. So I'd communicated.
Okay.
Sorry, guys. I know everyone's disappointed. Yeah. No, I wanted to thank, first of all, thanks a lot to Julia and Linda. Thanks. It's a great program. You know, it's really a who's who. You know, who's working in the CBDC and digital currency space. I really am glad to be here. I do research at the BIS on digital innovation, including CBDCs, crypto risks. There's been a lot of those materializing recently. I don't think that we have to dwell on that too much. I was going to mention that the BIS is actually putting out its annual economic report on Tuesday. It'll be on the future monetary system. So we've been working diligently on that in the last months. It includes a blueprint for the future monetary system with wholesale and retail CBDCs, fast payment systems, multi-CBDC arrangements. So I'll be curious what people think of that when it comes out. And I think that a lot of the discussions we've had yesterday and today are really relevant. I've also been working with Marianne, who's here, and Jean-Charles Rocher and Hyun-Song Shin on a piece on competing digital monies, and that'll be available soon, and we'll be very curious to get comments on that. But for today, I wanted to focus instead on this paper, joint work with Rafael Auer, Leonardo Gambacorta, Cyril Monet, Tara Rice, and Hyun-Song Shin. That's about the motives, economic implications, and the research frontier around CBDCs. So let me jump right in. I know that we're running a little behind schedule. So in a nutshell, the paper is a guided tour of this fast-growing literature on CBDCs, of which many people here have contributed. It's, in a sense, trying to bridge the divide between research and policy. There are a lot of papers that focus on the reserves for all aspects of CBDCs for retail use. There's a lot of policy work that's focusing on CBDC designs, on the use cases, on interoperability. So a lot of kind of more micro considerations but also some of the things on addressing risks of disintermediation, digital runs, digital dollarization. So a number of the macro risks, macro implications that the literature has identified are things that really central banks are taking seriously and working on in their design. As I'll discuss today, there are many different motives for CBDCs, which is perhaps not surprising. There are many central banks in the world, each with their own unique jurisdictional context. But overall, CBDCs should be considered kind of in the context of the digital economy relative to this counterfactual, what happens if CBDCs aren't issued. And there's especially a lot of concerns, a lot of issues that result directly from the centrality of data in the digital economy. So things around competition, around payment system integrity and privacy that I'll talk a little bit more about. The impact on financial stability and monetary policy may be more limited than is modeled in many cases in theoretical papers, and that's in large part because there are these design options that can mitigate some of these risks. So things around remuneration, around caps, around the architecture of who actually does retail services, and I'll talk about that. But there are a number of issues that really haven't been studied in sufficient depth, so especially issues around cross-border use of CBDC, around cross-border implications. And so for that reason, I was really happy with Will and Ziwon's paper. I think it's really important work, and I think there are a few papers that go in this direction of thinking about what are the spillovers across borders, what does it mean if China issues the ECNY and this becomes more widely used for trade invoicing, what does it mean if a digital dollar is introduced? So I think that those are really important, and I'll just briefly dwell on that and talk also about some of the work on multi-CBDC arrangements that I think also could actually have a pretty important impact in the future. So that's the overview, and I'll jump right in. Okay, so people here are probably aware, but I thought it's always good to start and be very certain we're all on the same page as to what we're talking about. So CBDCs, and a lot of the policy work have been defined as a form of digital money denominated in the national unit of account, which is a direct liability of the central bank. In the annex, I also have the money flower. It's still in bloom, if you will, and it allows you to distinguish, especially between kind of retail CBDCs or general purpose, which are accessible to households and businesses, and wholesale CBDCs that are accessible to financial institutions, including potentially non-banks, so not only banks. But importantly, like cash, CBDCs are central bank money, and that's fundamentally different. They're M0, if you will, and that's fundamentally different than private money, such as bank deposits, e-money, or for that matter, cryptocurrencies, which in many cases are not a liability of anyone. And if we think about retail CBDCs, a very simple way of thinking of it is that they are digital cash, that they are a direct claim on the central bank that's held by households and businesses, but in digital form. That doesn't necessarily mean that the central bank is directly offering retail services. There could still be a private payment service provider, a bank or a non-bank that does the KYC, that offers the user interface, et cetera, as has been the case in a lot of the pilots and live CBDCs. But importantly, it is a legal claim on the central bank, so it is M0, similar to cash. And that's different than bank deposits, which are, of course, a claim on a commercial bank. So there's been a lot of work in the last years. A lot of central banks have already been at this for some time. Rod and others have a great paper on the Ecuador case, so the dinero electrónico that was run from 2014 to 2016, then discontinued. And that can be seen kind of as the direct CBDC that I'll talk about in just a minute, so where the central bank really offers direct retail services. Other central banks, over time have been very active, especially Riksbank and MAS for quite a long time, and very open and communicating about what they're doing. The People's Bank of China has been working for much longer than is shown here. Work was not initially announced, but they've said since then, basically since 2013, 2014, they've been working on these issues. But of course, the context of this has changed a lot. A lot of central banks were doing internal work, experimentation. I know when I was at the Dutch Central Bank, there were a few guys with laptops that were trying to see how Bitcoin works and connecting it together and writing papers about this. But this moved into significantly higher gear, certainly in 2019, around the time of the Libra announcement. And I think a lot of central banks have been quite open. Even Bank of Canada has said that in thinking about the conditions under which a CBDC could be issued, if there were a global stablecoin that encroaches on the national currency, that's something that would make a difference. And I think the COVID-19 pandemic, again, was something that, kind of perhaps surprisingly at first, but in the end, really accelerated the discussion a bit. Also because of, the fiasco in the US of trying to get government aid to individuals, having to send paper checks or prepaid cards that people threw away. So I think that's also played a role. And recently, if you just look at the central bank speeches, we've tallied the speeches that central bankers have given over time, whether they mention retail and wholesale CBDC, whether they have a positive, negative, or neutral stance. You see this really clear trend that really since 2019, 2020, there's been a lot more discussion of CBDCs in general, but especially also retail CBDCs in a more positive light. And I'll be very curious, what'll happen during the next data update, particularly after the recent events in the crypto sector, whether, you could see this either way, that the crypto crash means that there's less urgency because now there's less of a threat from cryptocurrencies, or it could be that people want something more stable than what they've been using to date. So it is an open question as to how this develops. The number of projects has also shifted into higher gear. So there's been a lot more retail research projects, retail pilots, and even now some live retail CBDCs, and also more and more wholesale CBDCs. We were talking earlier about which countries in the world actually have a live CBDC, and we have our own database that's slightly different than the Atlantic Council one that Will referred to. We actually have checked with the central banks to confirm that we're getting their projects right. Currently, there are 3 live retail CBDCs that we're aware of. So it's in the Bahamas, in the Eastern Caribbean, and in Nigeria. Jamaica with Jamdex, so it looks like it'll actually go live this month. So the central bank I think the Senate just passed a bill making this legal tender, and the central bank has been rolling this out. And of course, people are aware of China, where it's a pilot, but it's a pilot with 260 million users, so it's a pretty big pilot. And of course, there's a lot of research and even in some cases some wholesale pilots in other jurisdictions, including work by the BIS Innovation Hub and central banks that are focused especially on cross-border payments that we'll talk about later. Okay, so this is just as backdrop. Now then the question is why? Why are central banks doing this? And I think we already got it yesterday. The motivations for different types of CBDCs may be very different for retail versus wholesale, for instance. And of course, the motivations are very different across jurisdictions. What the central banks say, at least, according to surveys, is that in advanced economies, those are AEs, the red dots here, that especially domestic payments efficiency and payment safety and robustness are quite important factors in advanced economies. to some extent also financial stability, and I think that has to be understood in the context of issuing a CBDC as an alternative to private cryptocurrencies or stablecoins that may be less stable or may have more problematic implications. In emerging market and developing economies, here the blue diamonds, it's especially financial inclusion that seems to focus pretty prominently, and also payments efficiency. And perhaps this isn't surprising because there are a lot of economies where a majority of adults doesn't have access to digital payment options, where payments are extremely expensive, where there's high rents, where they're very slow, and so their CBDCs are seen as an opportunity. Simon.
When you asked them, did you put these categories, or is this just what you heard? Did you ask an open question? Or like,
there is also an other, but
I see.
Yeah, this has been constant over the last years. It's really, these are the categories, and then within that they can also give some additional response.
Oh, I see.
Yeah. Okay. So this is a standard survey. And if we look at wholesale CBDCs, there's one kind of really interesting difference, which is that the payments efficiency cross-border matters a lot for both advanced economies and emerging market and developing economies. So we know that there are a lot of issues in cross-border payments. Cross-border payments are slow, expensive. There's a whole G20 initiative focused on cross-border payments. And central bank digital currencies are seen as a potential input into that, but especially on the wholesale side. And the multi-CBDC arrangements that link together CBDC systems in different jurisdictions, those are especially around wholesale CBDCs.
So all the issues that we had during the previous panels, where would central bank put that? Is that payments efficiency doesn't?
Yeah, so I mean, you can see like securities settlement and tokenization of real assets. You could see that as domestic payments efficiency, and certainly that's something that figures in there. And I think that some of the central banks actually did refer to that as well in their wholesale CBDC work. So in the responses,
it's almost like since 2018 and now, right? This is there could have been a new question maybe.
Yeah, absolutely. I mean, I think that. So this is the survey, and I'll mention then that there are these broader issues. We've also looked at there's what the central banks say, and then we've looked at kind of the revealed policy preferences. So we've done empirical work looking at what are the factors that actually correlate with CBDC work, and we find that it's things like existing digitization in the economy, the size of the informal economy. For retail CBDCs, and for wholesale CBDCs, it's also the depth of financial markets. So where financial markets are deeper already, there may be more demand for more efficient clearing and settlement. So this, I think, relates with what we were discussing or what was discussed in the last panel. But on the retail side, I think that there's a more general issue, which is central banks are considering the CBDCs relative to the counterfactual of not acting. So there is, of course, a lot of activity in the crypto space, and I think even despite the recent crash, I think that the move toward using DLT applications, toward alternative payment instruments, I mean that's ongoing, and I think that there are also these broader issues that relate from the centrality of data in the digital economy. So personal data are being collected in a kind of exponentially growing scale. And there are issues around competition, so especially that new players are able to use their data advantages to scale very quickly, grow very fast. This was some of the concern around Libra, that a big tech that already has access to this personal data, that has this giant network of 3 billion users, can very rapidly scale. And we've seen also in China that the big techs have been able to scale up very rapidly and really dominate the payment market. The People's Bank of China has said very explicitly that the ECNY should be seen as a response to this duopoly that they currently have in the payments market. Then there's the issues around privacy. Again, very obvious that transactions data, can be very sensitive. There are issues around that. I think there's good work discussing CBDCs in the context of privacy and also the externalities that can arise because of people's choice of payment instruments. And there are issues around integrity. So you can have anonymous payments. You can have pseudo-anonymous payments on a blockchain where the ledger is visible, but you don't know the identities. And so there are, these issues figure really prominently in the discussion. And I think that, this has been also an invitation to some extent to central banks to think about it, for societies beyond central banks to think about how they want to structure, money, the control over data, the division of labor between the public and private sector. And so, to some extent, CBDCs or this context of the centrality of data in the digital economy have been an invitation to think about these issues, and it's perhaps not surprising that we're still debating about what potential is there and what are the particular issues that CBDCs would be addressing. All right. So I wanted to then talk about the microeconomic considerations, and this is really where the policy discussion has been. How do we design CBDCs, given that there are these motivations, particularly around domestic efficiency, around financial inclusion, around robustness. So I think there are a number of design choices that central banks have to make, and we've categorized these in basically 4 buckets. So the foundational one is, really the architecture. It's the role of the public and private sector. What does the central bank do versus private, payment service providers, banks and non-banks? The second one is the infrastructure. Do we use distributed ledger technology or something else, conventional infrastructures? The third is the access technology, broadly, whether it's account-based or token-based, so whether it's based on identification or not. And then the interlinkages, how is it interlink across borders? What does this mean for foreign use also of the CBDC? And there are discrete design choices in each case, but I think especially in this foundational layer, it seems like there's kind of an emerging dominant trend, and I'll talk about what that is. So if we think about the architecture, then I'll just sketch three possibilities. So one possibility is this direct model of CBDCs. It involves a very large operational role for the central bank, and this is essentially what what was done in Ecuador. The central bank interacts directly with users and merchants. There's a direct legal claim on the central bank. The central bank also, is party to these data flows, so they know that people's balances, people's transaction. Because they're interacting directly, they also know their identity, and they maintain this full ledger. So essentially, the central bank is directly offering these services in the economy. Now, there are some potential issues with that. The one important one being that there's kind of dramatic disintermediation of the banks potentially. Another one being the central bank has access to all of this really sensitive information. It might become also a honeypot, a target of cyber attacks. So there are a lot of reasons why, and it involves a very large operational effort, of course, to maintain this system. An alternative is an intermediated model. And in an intermediated model, you still have PSPs. Those can be banks or non-banks. And much like in today's system, they each record their own clients' transactions. The CBDC only has a wholesale ledger, but what's different from today's system is that it's M0, that it's a legal claim on the central bank. So there is a central bank system, but maybe the central bank doesn't actually have the individual transaction data. And then in between there's this hybrid model where the central bank does have the full retail ledger, but again, there are PSPs, and again, there's this direct legal claim. And for instance, of the live CBDCs I was talking about, the Sand Dollar in the Bahamas is an example of the hybrid model. The ECNY pilot in China is also an example of the hybrid model. And interestingly, the fact that the central bank has the full ledger doesn't necessarily mean they have identity information. And in fact, in the Bahamas and in China, the PSPs are still responsible for doing the KYC, for instance. They actually do the onboarding of customers. And so the central bank doesn't have the identity information behind individual addresses or individual accounts. And there is also, in the Bahamas, they've clarified that if law enforcement needs access to that information, they need to get a court order. They can go to the PSP to get the identity information, the central banks to get the transactions data, and then the law enforcement can combine them, but only under certain conditions. So if you think about these three models, broadly, the direct model involves the highest operational involvement of the central bank. The intermediate model involves, relatively more operational involvement of the PSPs, less of the central bank, and the hybrid model is in between those two. And if you look in practice, it seems that most central banks that have made a decision on this actually are in the hybrid or intermediated category. There's some cases where there's a little bit of ambiguity about, which of the two, either hybrid or intermediated. There are very few central banks that are considering a direct model. In fact, even these these few, it's just been in the context of research, not in the context of live CBDCs or projects. And some are considering multiple models where perhaps the central bank, would offer something directly in addition to private PSBs. On infrastructure, there's a bigger spread. There are some that are considering conventional, some that are considering DLT, some that are exploring both, and quite a few that are undecided. There's a lot of retail CBDC research where they haven't really decided yet what infrastructure they would ultimately choose. Also on access, account versus token-based, there's quite a big spread. Interestingly, since we've started collecting the data on interlinkages, there's been a big increase in the international use. So initially, very few central banks were considering any international use of a retail CBDC. They were thinking, that this would be for domestic residents only. Over time, there have been more that have said, foreign tourists, business travelers could also use the CBDC, or it could even be used for trade invoicing across borders. And now I think, especially with the multi-CBDC arrangement discussion, again, which is more in the wholesale CBDC space, there's even more interest in kind of the cross-border use and the potential to support cross-border payments. Okay. So then we'll get more to the macro side, and what does this mean for banks, for financial stability, and for monetary policy? And of course, these are a crucial set of questions, and crucially, will CBDCs disintermediate the banking sector? And so I think we've also gotten to hear some of the models and some of the further work in this area. I think is continuing to develop. But broadly, models to date, a number of models, including by David, Rod, Harold, and Linda, and others, consider the impact of CBDC issuance on the banking sector. They're often differing in terms of competition in the banking sector, whether we have perfect competition or perfect monopoly or something in between. But the logic, I think, in many cases is that offering a CBDC, the central bank can induce commercial banks to make their deposits more attractive. That can increase the cost of funding. There may be a shift between deposits and CBDC holdings. And I think that this this gets at a really interesting set of questions. There's kind of we I think heard mentioned earlier today already of the kind of the Modigliani-Miller equivalent. About the equivalence of public and private money. When does this break down? What are the concrete differences between basically M0 and M1? There's this discussion of what this means for bank runs, and of course a big difference between a CBDC and a stablecoin, or other new payment instruments is that with a CBDC, a run to a CBDC would be on the central bank's balance sheet, and the central bank can of course potentially re-lend back to the banks. So that could mitigate bank runs to some extent. There may be changes in the frequency, both the frequency of bank runs and the severity of runs. So Williamson, one of his results is that the possibility that runs could be more frequent but less severe. So I think there's a lot more work to be done here to really settle the issues. But I think that certainly in the discussions that a number of central banks are having on their own CBDC projects, a lot of them are considering non-remunerated designs, so not offering interest, not paying interest. Some central banks are even considering explicit limits on CBDC balances. So Binsile made this proposal, and actually just a few days ago, Panetta again reiterated that there may even be an absolute cap on the size of the digital euro. And so I think that this is really relevant because this is an important concern. But I think that central banks are at least seeking to design their CBDCs in such a way to preserve private lending in the two-tier monetary system. So really to mitigate these effects that have been flagged in the models. And then there's the question about will CBDCs fundamentally alter domestic monetary policy? And of course, this discussion about whether CBDCs can help break the zero lower bound, that seems a little bit moot, at least in the near term. We're not in quite that world anymore. But I think that discussion was already, and perhaps this is not a surprising answer, but that discussion was already a little bit, if we're thinking about a world in which cash will still exist, there's obviously some limits as to how deeply negative you can go with interest rates, because people are just going to switch to cash. If you have a CBDC that you want people to adopt, and then you start paying negative interest on it. There is the question about could CBDCs provide new monetary policy tools to central banks? Could they provide helicopter drops? I think David said that would be a great use case for it. And Yeah, I mean, I think that that's an open question, but then, you know, there are also these questions about the blurring of fiscal monetary boundaries and what this means if the central bank is doing, you know, essentially what governments would do otherwise. And then there's this discussion, I think this already segues to what I'll be going to next. I think there's this really interesting discussion, not of what it does domestically, but, you know, what it does across borders. Could it be that if you have CBDCs and they can be used by non-residents, can that change the transmission of monetary policy shocks across borders? And Ferrari and others have a great paper that really goes into that and actually finds that there could be an amplifying effect of the cross-border transmission of monetary policy shocks. But I think an important thing to mention is that, as you guys saw from the survey results, monetary policy doesn't seem to be a key driver for most of the CBDC work. It seems that, if anything, you know, central banks have other considerations in mind, and they're more worried about how can we mitigate the impact of monetary policy. But, you know, again, different central banks have their own context and own considerations on that.
I guess my question was about this. So
Okay, good. All right, there's a lot of work on the, and I think a lot of interest in the cross-border impact of CBDCs. And I think that one of the first issues that comes up a lot is, you know, what does this mean for international reserve currency competition? And I think especially, you know, as Will and Simon have sketched, you know, there's the People's Bank of China doesn't say that the ECNY is an attempt to, you know, make the renminbi into a reserve currency, but there's the suspicion, well, maybe that's part of the plan. I think, though, that, you know, clearly there are other factors that play an important role in reserve currency status. The one important one being the absence of capital controls, another important one being the depth of capital markets. Those things are not influenced by the presence of a CBDC, and it seems like as long as, you know, a country has extensive capital flows in place, does not have deep capital markets, as long as there are maybe you know, concerns around you know, institutions and long-run you know.
On that, John, is
Yeah.
it possible that there is an arbitrage at some point because of demand and supply between the fiat and the CBDC?
So explain, what do you mean?
So for example, if let's say the demand for the fiat is X, right?
Yeah.
The demand for CBDC is Y. And then the retail has certain demand and wholesale. So just like in real life, anything wholesale and retail is priced differently.
Right.
Would the same apply to CBDC? And second, as trade grows, and let's say that digital is more in demand,
Yeah.
will it create an arbitrage with the traditional fiat?
Okay, so that's a good question. I mean, so yeah, whether there is this arbitrage opportunity, and I think that at the margin, you know, certainly a CBDC could make, you know, that currency more convenient. And I think that, you know, if ECNY, for instance, is used on the Belt and Road Initiative, if it's used for cross-border trade in that immediate region, at the margin, certainly that means that there's more foreign demand for for the renminbi, and it means that, you know, potentially you could have some. But I think that the important thing to mention is that's a little bit second order relative to this kind of, I don't think that necessarily encourages a central bank to start buying renminbi denominated assets and keeping them as national reserves. You had a question, go ahead.
Just to add to his point and what he said, I believe there would always be an arbitrage between a CBDCs or a digital asset versus a currency where there are strict capital controls, because for countries like India, Pakistan, Bangladesh, and for that matter even China, when you allow free flow of capital but the government is trying to control it, and then you bring something as CBDCs or any virtual asset in the picture where you can freely move capital out of one country to other,
Right.
then it definitely creates an arbitrage or a black market of some sort. So I have been looking into this problem for various countries, specifically Southeast Asia and some African countries even, such as Nigeria. There is a whole lot of arbitrage, about 20 to 25%, where you can just keep on looping in, but it does not materialize because the capital outflow is not there, and that would remain with CBDCs as well. So although it's a way of not dollarizing your economy, but as mentioned in the previous presentation, somehow if cross-border transactions happen, it would ultimately lead to dollarization of economy.
Okay. Yeah, I guess this is another area where there are differences again in design. So I mean, if you have an account-based CBDC or you have a CBDC that's based on strong identification, then obviously central banks have some, you know, both in the issuing country and potentially also in the host country, have some instruments to you know, deal with that. And I think that's also been a point of discussion. You know, you can see that in a favorable light in the sense that the central bank has tools to mitigate capital flight, or you can see it in, of course, a more pernicious light, depending on your view of the central banks in question. Were there other questions? No, okay. So I wanted to mention, I think this is an area, and we discuss in the paper how this is really the research frontier. We think that there's a lot more work that needs to be done on the cross-border implications of CBDCs. And, you know, there are aspects, you know, there's the discussion around international reserve currencies. There is the discussion of the cross-border transmission of monetary policy. You know, there's the potential impossible trinity, and so there's the, you know, what this means also for you know, for capital flows. But I think that there's an important, and this is again relating back to some of the work that's ongoing by a number of central banks and at the BIS. There is also the potential for CBDCs to facilitate more efficient cross-border payments. And I think especially the multi-CBDC arrangements, again, you know, we're talking about wholesale CBDC models, but you know, this is a model in which there may be either more harmonized CBDC systems in different jurisdictions, or interlinking systems, or even a common platform that's run by multiple central banks, potentially on a permissioned DLT platform. And that can allow for, you know, a much simpler monetary architecture, and it could streamline the cross-border payment chain. So if you think about today's cross-border payments, where you have a system of correspondent banks, and so between the payer and the payee, there may be a number of links, and then of course the FX market. You know, this can introduce additional costs and inefficiencies along the way. An MCBDC arrangement involves the central banks being able to issue central bank money on a shared platform, and commercial banks and potentially other financial intermediaries in different jurisdictions being able to access not only their own central bank's M0, but also that of other jurisdictions. And so, of course, you still, between a payer and payee, you would have the payment services provider. But then you have this, much more direct link because the central banks have this common system. You still need the FX conversion, but the experiments to date at least have shown that there are a number of cases where the speed has been reduced significantly. So the time can go from a few days to several seconds, where the cost can be reduced significantly. And this ultimately could be a competitor to the system of correspondent banks, and then potentially have some efficiency gains.
Do you know where the discussion is on? I mean, again, thinking about the panel before, right? If this is all on distributed ledger technology, by having two central banks issuing their own CBDC, if they share the same ledger, that will be maybe infringing on each autonomy of each central bank, right? Creating all kinds of issues. But if these are different ledgers, then that may put frictions into that market again. So
agreed. Yeah. So I think that
maybe a mixture of the. I mean, it's sort of this whole. How do these chains talk to each other? And,
yeah. No, I think that there are broadly three models for the arrangements, and they correspond pretty closely to what you were just saying. So there's a model where you essentially have separate ledgers, but they at least have the same technical standards, so they can send information across and it's recorded on different ledgers. There's a model where you have a single ledger and a single shared system, which obviously requires a lot more coordination, and central banks may have views on whether that fits into their mandate and whether that's possible. And then you have a model in between where you have the ability for central banks essentially to take part in one another's system and to be able to record on the ledger of the other central bank, if you will.
But then, I couldn't possibly imagine a central bank being active on two ledgers, right? Because then it's almost like they're issuing two currencies. So that creates. Yeah.
So I mean, it's possible. It's
technically possible.
Yeah. So this is essentially the interlinking. So it's a little bit like the bridges in the crypto world, if you will. And in the crypto world, I mean, the bridges are notoriously insecure. There have been the Axie Infinity hack and other examples, because there's often a high degree of centralization. If we're talking about a permissioned network and where you have trusted nodes that would be able to do that, then you could at least deal with some of those issues. Yeah. But yeah, those are exactly the models. And I think that there are a few experiments, including the M-Bridge, which involves the People's Bank of China, the Hong Kong Monetary Authority, Bank of Thailand, Central Bank of the UAE, and the Innovation Hub. So that's one that's, where the central banks in question have been willing to actually create a shared system. So that's the, kind of most far-reaching model. And there are other projects, Project Dunbar was between Singapore, Australia, South Africa, others. Yeah, I think that they're also considering this kind of a system, but it's still experimentation, and ultimately it's kind of a policy question as to what central banks are willing to do and how much they can coordinate amongst one another.
But retail CBDC, it's fair to say that eliminates, like every day there's a fake bunch of dollars being seized and so on, right? I mean, it eliminates that, right?
Sorry, what?
Like fake currency, right? The bad actors keep printing fake currency, right?
Right, so counterfeit, yeah. Yeah, I mean, essentially, the design system is such that you have basically the counterfeit issue that, you have to make sure that it's a legitimate digital currency and that you don't have double spending, but yeah, they're architected to deal with both of those, so you would. I think we're getting near the time, so I'm actually at my last slide in any case. I just wanted to say that there is a growing global body of work on central bank digital currencies. I think that it's actually unique in that this is an area of economic research that, really has policy impact in practice. And I think that, a lot of the research to date has been focusing on the reserves for all aspects of CBDCs for retail use. In practice, I think central banks, as I've discussed, have been, cognizant of some of these risks and actually trying to design CBDCs in such a way to mitigate them. I talked about the microeconomic considerations related to operational architectures, technologies, and privacy, macroeconomic implications for the financial system, financial stability, and monetary policy. And I think just the last point that I'd leave you with is that there are a lot of questions around cross-border dimensions of CBDC that remain unresolved, and that's calls for further work to expand the research frontier. Thanks a lot.